Legal. The information presented in this video, including all spoken narration, on-screen text, and graphical representations, is strictly for educational, informational, and entertainment purposes only. This content does not constitute financial, investment, legal, or tax advice. The financial markets, particularly the foreign exchange Forex market and the use of automated trading systems, algorithmic software, or AI bots, involve a significant level of risk and are not suitable for all investors. There is a substantial risk of loss, including the potential loss of all invested capital. Past performance of any trading system or methodology is not necessarily indicative of future results. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading and may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. The creator of this content is not a registered financial advisor or broker-dealer. Viewers are strongly urged to conduct their own due diligence and consult with a qualified, licensed financial professional before making any investment decisions. By watching this video, you acknowledge that you are solely responsible for your own financial decisions and agree that the creator and channel assume no liability for any direct or consequential loss or damages arising from the use of the information contained herein. 99%. That is the win rate you will see plastered across the sales pages of the most popular AI Forex trading robots on the internet today. They show you a smooth, upward-sloping equity curve that looks like a staircase to heaven, claiming to turn a few $100s into a retirement fund while you sleep. But here is the statistic they will never show you, the one that is buried deep in the fine print of broker reports and regulatory filings. 90% of retail traders lose 90% of their capital within their first 90 days of trading. When you introduce unregulated black box AI scripts into that equation, the speed of that loss often accelerates from 90 days to 90 minutes. We are currently witnessing one of the most sophisticated wealth transfers in the history of the retail internet, fueled by the massive hype surrounding artificial intelligence. Since the release of ChatGPT and the mainstream adoption of large language models, the term AI has been hijacked. It has been slapped onto old, dangerous algorithms, systems that have been blowing up accounts since 2008, to repackage them as cutting-edge technology for a new generation of unsuspecting investors. You are being sold a dream of high-frequency, neural network-driven passive income, but the reality is often a simple, hard-coded grid system, waiting for one volatile news event to wipe your balance to zero. If you are watching this, you have likely seen the ads. You have seen the influencers posing with rented supercars, showing off MetaTrader 4 screenshots with blue profit numbers cascading down the screen. You might have even felt the temptation to buy a license, thinking that maybe this time technology has finally bridged the gap between Wall Street institutions and the retail trader. But you need to understand what you are actually up against. The institutional algorithms that dominate the Forex market, the ones running in data centers in New Jersey and London, operate on nanosecond latency, utilizing infrastructure that costs millions of dollars a month to maintain. They are fighting for fractions of a pip. Do you honestly believe a $99 downloadable executable file, running on a laggy virtual private server, has found an edge that Goldman Sachs and Renaissance Technologies missed? Or is it more likely that the edge being sold is not in the market, but in the marketing itself? This video is not just a review. It is a forensic analysis of an industry built on smoke and mirrors. We are going to dismantle the black box. This is a deep dive masterclass. Over the course of this series, we are not just going to talk about these robots, we are going to reverse engineer them. We are going to look at the code structure to determine if there is actually any artificial intelligence or machine learning involved, or if it is just a disguised martingale strategy, a gambling method that doubles down on losing trades until the account creates a margin call. We are going to take the exact files these vendors are selling, and we are not just going to run their optimized backtests, which are often curve-fitted to look perfect on past data. We are going to run stress tests across 10 years of high-volatility tick data, simulating real-world slippage, variable spreads, and broker commissions. We will expose the difference between a backtest and a live forward test, and why a robot that turned $1,000 into $1 million in a simulation will almost certainly lose everything in a live environment. We are going to explore the conflict of interest between you and the brokers who often promote these bots, specifically the B-book model, where the broker profits directly when you lose, creating a perverse incentive to recommend software that fails. For the US audience specifically, this is a critical moment. The regulatory environment in the United States, enforced by the CFTC and NFA, is strict for a reason. It limits leverage and bans certain hedging practices precisely to protect against the types of aggressive algorithms we are going to discuss. However, the internet has no borders, and many of you are being lured into offshore, unregulated brokers to run these high-risk AI bots, stepping outside the safety net of U.S. consumer protection laws. You need to know the legal and financial implications of moving your capital into these gray zones. We are looking at a market environment right now that is defined by uncertainty, interest rate shifts from the Federal Reserve, geopolitical instability, and banking sector fragility. These are market conditions where standard correlations break down. An algorithm that was trained on the stable bull market of the last decade is not equipped to handle the violent whipsaws of the current economic climate unless it possesses genuine adaptive capabilities. And spoiler alert, most of them do not. The promise of this masterclass is clarity. By the end of this series, you will no longer be a target. You will understand the difference between a simple, if-then logic script and a genuine conceptual machine learning model. You will know how to read a MIFSPOOK track record and spot the manipulation techniques used to hide floating losses, the drawdown that exists in the background while the closed trades look profitable. We will categorize these robots into their true families: the scalpers that die by the spread, the grid systems that die by the trend, and the arbitrage bots that get your account banned by the broker. We are going to move past the hype of passive income and look at the cold, hard data of algorithmic trading. This is not about getting rich quick. This is about not getting poor slowly through a subscription fee or quickly through a margin call. We are going to treat this with the seriousness of a university lecture combined with the investigative rigor of a forensic audit. We will define the vocabulary of the quantitative analyst: Sharpe ratio, profit factor, maximum drawdown, expectancy, and ruin probability. You will learn that a high win rate often correlates with a poor risk-to-reward ratio, meaning one bad trade can erase months of small wins. We will examine the psychological trap of the sunk cost fallacy that keeps traders attached to failing robots, hoping the market will turn around. This is about financial literacy in the age of automation. The tools available today are powerful, yes, but they are double-edged swords. If you do not understand how the weapon works, you are far more likely to hurt yourself than the market. Before we proceed to the dissection of the first category of bots in the next section, ask yourself, why would a developer sell a money printing machine for a monthly fee? If you had an algorithm that could genuinely, consistently extract millions from the Forex market with zero risk, would you package it and sell it on a saturated marketplace for $49, creating competition for your own trades? Or would you safeguard that secret with your life and compound your own capital quietly? The answer to that question is the foundation of everything we are about to explore. The business model of the Forex robot industry is rarely about trading. It is about software sales and affiliate commissions. And today we stop buying the sales pitch and we start looking at the source code. Welcome to the truth about AI Forex trading robots. You download the file. It usually ends in a simple extension like .x4 or .x5, depending on whether you are using MetaTrader 4 or 5. You drag it into your experts folder, restart the platform, and see a little smiley face in the top right corner of your chart. That smiley face is the universal symbol that your automated trading robot is live. The vendor promised you it uses advanced neural networks and deep learning to predict market movements with surgical precision. But if you could actually crack open that compiled file and look at the raw code underneath, you would likely find something that would terrify you. The vast majority of systems sold to retail traders as artificial intelligence are nothing more than simple linear logic scripts, technically known as expert advisors or EAs. There is zero intelligence involved. True artificial intelligence, specifically machine learning, involves a system that ingests data, learns from patterns, reweights its own decision-making parameters, and adapts to new information without human intervention. It evolves. The bot you just bought for $200 does not evolve. It obeys a static set of rigid rules hard-coded by a programmer 6 months ago. It is typically a series of if-then statements. If the relative strength index goes below 30, then buy. If the price moves against the trade by 20 pips, then buy again. This is not AI. This is a glorified calculator with a gambling addiction. To understand why this distinction is critical for your bank account, we need to analyze the most common algorithm disguised as AI, the grid system, often paired with a martingale money management strategy. This is the dirty secret behind almost every high win rate robot on the market. Imagine a scenario. You install a bot called Safe Profit AI. The market is trending slightly down. The bot executes a buy order at 1.1000. It is betting the price will go up. but the price drops to 1.0980. A real AI model might analyze sentiment, realize the trend has shifted, and cut the loss immediately. But Safe Profit AI is hard-coded to never accept a loss because losses look bad on the marketing brochure. Instead, it opens a second buy order at 1.0980, but this time it doubles the lot size. This is the martingale effect. The logic is seductive. If the price just bounces back a tiny bit, the profit from the second, larger trade will cover the loss of the first trade and add a small profit on top. Feels like magic. You look at your phone and you see blue numbers. Win-win-win. The bot shows a 99% win rate. But let's look closer at the mathematics of catastrophe. If the market drops another 20 pips, it opens a third trade, doubling the size again. Then a fourth. Then a fifth. Let's do the math that the sales page ignores. You start with a tiny 0.01 lot trade. By the 10th level of this grid, you are not trading 0.10 lots. You are likely trading over 5.0 standard lots depending on the multiplier. To sustain a position that size, you need massive amounts of margin, capital held by the broker to keep the trade open. In a calm market, the price bounces back, the bot closes everything in profit, and you feel like a genius. But the Forex market is not calm. It is a beast prone to black swan events. Unexpected shocks like a central bank intervention, a surprise war declaration, or a global pandemic. Imagine it is a Friday afternoon. The US non-farm payrolls data is released, and it misses expectations by a historic margin. The US dollar crashes. The chart does not zigzag. It falls in a straight vertical line. Your AI bot does not know that the Federal Reserve Chairman is speaking. It only knows its hard-coded logic. Price dropped by more. Keeps buying all the way down the crash. Within minutes, your equity, the actual liquid value of your account, plummets while your balance stays high because the trades haven't been closed yet. This is the float. Eventually, you hit the broker's stop-out level. The broker forcibly closes all your positions to cover their risk. In one single afternoon, 3 years of slow, steady gains are wiped out, leaving you with zero. The robot didn't fail in terms of its code. It did exactly what it was programmed to do. It was programmed to blow up your account. It was just a matter of when. Now, compare this to what institutional algorithmic trading actually looks like. When hedge funds like Renaissance Technologies or Two Sigma use machine learning, they are not looking at a simple moving average crossover. They are ingesting terabytes of alternative data. They are analyzing satellite imagery of retail parking lots to predict earnings, scraping millions of tweets per second to gauge global sentiment using natural language processing, and monitoring the milliseconds of latency in order flow from exchange to exchange. Their models are probabilistic, not deterministic. They do not seek a 99% win rate. They are often happy with 51% because their risk management is impeccable. They cut losses instantly. They are playing a completely different game than the retail trader with a $200 bot. So why do the retail bots show such amazing backtests? If they are so dangerous, why does the history look so perfect? This brings us to the concept of overfitting. Suppose you are a student preparing for a history exam, but instead of learning the events, you manage to steal the answer key. You memorize that the answer to question 1 is A, question 2 is C, and so on. You take the test and score 100%. You look like a genius. But then, the teacher changes the questions for the final exam. You fail immediately because you never learned the subject, you just memorized the past answers. This is exactly what scam developers do with trading robots. They take historical data, say the euro to US dollar price action from 2020 to 2022. They run an optimization algorithm that tweaks the settings of the bot millions of times until it finds the exact combination of parameters that would have made the most money during that specific period. They curve fit the strategy to the past data. When they show you that backtest, they are showing you the memorized answer key. It looks flawless. But the moment you turn it on in the live market, the future does not look exactly like the past. The market changes the questions. The volatility is different, the spreads are different, the correlations are different. The overfitted bot, unable to adapt because it isn't real AI, collapses. Furthermore, we have to talk about the execution environment. The backtest assumes a sterile environment. It assumes zero slippage, meaning you get filled at the exact price you wanted. It assumes a fixed spread. In the real world, liquidity is fluid. During a high-impact news event, spreads can widen by 10 or 20 pips instantly. A stop-loss order you set at 1.0500 might not get triggered until 1.0480. That difference, called slippage, destroys the mathematical edge of high-frequency scalping bots. The developer knows this. They know their bot cannot survive real-world spread widening, yet they sell it to you anyway, often recommending unregulated brokers with questionable liquidity providers. You are essentially bringing a knife to a nuclear war. The sophisticated HFT, high-frequency trading, firms are the ones providing the liquidity you are trading against. They can see the order flow. They know where the clusters of retail stop losses are sitting. Often, the market will move specifically to hunt that liquidity, to hit those stops before reversing. A static AI bot places its stops in predictable places, based on obvious indicators that everyone is watching. It makes you an easy target. Real AI would recognize that the market structure has changed and adapt its entry criteria. A static script just walks blindly into the trap over and over again. This ecosystem of deception relies on your lack of technical knowledge. They rely on you not knowing the difference between a neural network and a grid loop. They rely on you looking at the balance line and ignoring the equity line. But the deception goes deeper than just the code. It extends to how these results are verified and displayed to the public. You might be thinking, but I saw a verified MIFSpook link. It was a third-party audit. You need to understand that even third-party verification sites can be manipulated if you know the loopholes. There are ways to hide losing trades, ways to manipulate the start date to hide previous blowups, and ways to trade on demo feeds that do not reflect real market liquidity. We are peeling back the layers of an onion that is rotten to the core. We have established that the code is rarely AI, and the strategy is often a ticking time bomb of leverage. But how do you spot the specific red flags on a track record before you hand over your credit card? How can you look at a graph and instantly tell if a system is a legitimate trend follower or a dangerous grid waiting to crash? In the next part of this masterclass, we are going to become forensic auditors. I am going to show you the specific visual patterns in performance graphs that scream scam. We will discuss the Sharpe ratio deception and why a smooth line is often the most dangerous signal of all. You are about to learn how to spot the lie in the data. Shutterstock. Explore. When you land on the sales page of a high-ticket AI trading bot, your eyes are immediately drawn to one thing: the performance graph. It is almost always a beautiful 45-degree line, ascending from the bottom left to the top right. It looks like a staircase built of pure gold, with practically zero dips. It is hypnotizing. It triggers a dopamine response in your brain that says, "This is it. This is the answer." But in the world of professional quantitative finance, a smooth equity curve is not a sign of perfection. It is the single biggest warning sign of impending doom. Real trading, legitimate, sustainable, edge-based trading is messy. It has peaks and valleys. It has periods of stagnation known as drawdown, where the strategy is out of sync with the market. A graph that never goes down is a graph that is hiding a catastrophic risk. And today we are going to learn how to see the invisible danger lurking behind that smooth line. You need to understand the fundamental difference between two numbers on your trading statement: balance and equity. This is where the deception happens. Balance is the amount of money in your account based on closed trades. If you start with $1,000 and close a trade for $10 profit, your balance is $1,010. Equity is your balance plus or minus the value of all currently open trades. If you have that same $1,010 balance, but you are holding a losing trade that is currently down $500, your equity is only $510. The AI robots that show those perfect, smooth graphs achieve them by simply refusing to close losing trades. They let the losses float. On the public tracking pages like MIFSpook, scam vendors often obscure the equity line or hide the open trades data, showing you only the balance. They are showing you the closed profits while hiding the open hemorrhage. We call this the alligator jaws effect. If you were to overlay the balance line and the equity line, you would see the balance rising steadily like a staircase, while the equity line dips deeply below it, occasionally snapping back up when the market luckily reverses. That gap between the two lines represents the risk of ruin. It represents the float. As long as the market eventually comes back, the robot closes the trade in a small profit, the equity snaps back to the balance, and the graph remains perfect. But the moment the market enters a strong, unidirectional trend that does not retrace, which happens in the Forex market roughly every 3 to 5 years during major geopolitical shifts, the alligator jaws open so wide that they swallow the entire account. The equity hits zero, the broker initiates a margin call, and that beautiful 45-degree line falls off a cliff in a single vertical drop. This brings us to the manipulation of statistical metrics, specifically the Sharpe ratio. In institutional finance, the Sharpe ratio measures risk-adjusted return. A higher number is usually better. However, Grid and Martingale bots effectively hack this metric. Because they artificially suppress volatility by not closing losers, their standard deviation of returns appears to be almost zero. This gives them an astronomically high Sharpe ratio, often above 3.0 or 4.0, which is unheard of for legitimate hedge funds. If you see a Sharpe ratio that looks too good to be true on a retail bot, it is not because the algorithm is a genius, it is because the algorithm is hiding the tail risk. It is picking up pennies in front of a steamroller. The metrics say the strategy is safe right up until the exact millisecond the steamroller crushes it. Let's look at a practical case study of how this plays out in the real world. Consider the Swiss franc black swan of January 2015. For years, thousands of AI grid bots were scalping the euro to Swiss franc pair. The Swiss National Bank had pegged the currency, keeping volatility artificially low. It was a paradise for these robots. They showed years of perfect, undefeated results. Traders poured their life savings into these systems, convinced by the historical data. Then, in one morning, the central bank removed the peg. The pair dropped thousands of pips in minutes. Every single robot that was holding floating losses on the expectation of a reversion was instantly wiped out. Not just to zero, but often to a negative balance, leaving traders owing money to their brokers. The historical data that showed a 99% win rate was mathematically correct, but effectively worthless, because it did not account for the structural break in the market. Furthermore, we must address the verified status on third-party tracking sites. Just because a system has a green checkmark saying track record verified, does not mean the system is honest. Savvy vendors know how to game these platforms. One common tactic is the start date manipulation. A developer might run 10 different versions of their bot on 10 different accounts. 9 of them blow up in the first month. One of them gets lucky and survives. The developer then deletes the 9 failed accounts, links the one surviving account to MIFSpook, and sets the custom start date to the day after any initial drawdowns, creating the illusion of a pristine history. This is known as survivorship bias. You are looking at the one lottery winner and assuming the system produces winners, ignoring the graveyard of failures behind the scenes. Another layer of deception is the demo versus real spread environment. Many of these viral results come from demo accounts. On a demo account slippage, the difference between the price you want and the price you get is often non-existent. Liquidity is infinite. If the robot wants to buy at 1.0500, the simulation gives it 1.0500. In the live market, specifically during news events or high volatility, real liquidity dries up. If the robot tries to close a basket of trades to save the account, it might get filled at 1.0490, 1.0480, or worse. That difference destroys the profitability of high-frequency scalpers. A bot that makes $1 million on a demo account can easily lose money on a live account purely due to execution latency and spread widening. Unless the track record explicitly states real USD, on a reputable, regulated broker, the data is essentially fiction. You also have to be wary of arbitrage bots. These systems exploit the latency difference between a slow broker and a fast data feed. They see the price move on the fast feed and place a trade on the slow broker before the price updates. On a graph, this looks like free money. It produces a perfect risk-free equity curve. But here is the catch. It is essentially theft from the broker. No broker allows this. You might buy the bot, run it, and see profits for 2 weeks. Then you try to withdraw your money. The broker reviews your trade logs, flags the arbitrage activity, voids all your profits, and closes your account for violating their terms of service. The vendor who sold you the bot walks away with your subscription fee, and you are left fighting a legal battle with an offshore broker you will never win. The forensic audit of a trading robot requires you to be a cynic. You have to look for what is missing. Is the floating P/L tab hidden? Red flag. Is the trade duration purposely obscured? Red flag. Does the lot size increase after a loss? That is the martingale death spiral. You need to stop looking for the high returns and start looking for the risk management. A legitimate algorithmic strategy will have a jagged equity curve. It will have losing months. It will have a flat Sharpe ratio. But it will have a stop loss on every single trade that is respected. It protects capital first and chases profit second. Now that we have dismantled the fake code and exposed the manipulated graphs, we have to talk about the venue where this game is played. You might have the best, most legitimate robot in the world, but if you run it on the wrong broker, you are doomed to fail. There is a conflict of interest in this industry so deep and so pervasive that it borders on criminal. Most retail traders do not realize that their broker is often their adversary. In the next part, we are going to expose the B-book model. We will explain why your broker might be betting against you, why they might be intentionally adding lag to your bot's connection, and how the entire free commission structure is a trap designed to bleed your algorithm dry. Imagine a casino where the dealer not only knows your cards, but can also change the rules of the game while the hand is being played. This is, in essence, the operational model of a B-book Forex broker, and it is the hidden graveyard where thousands of AI trading robots go to die. To understand why your algorithm fails, you must understand the venue in which it operates. In the retail Forex industry, there are two primary ways a broker executes your trade: the A-book and the B-book. When you trade with an A-book broker, also known as an STP, straight-through processing, or ECN electronic communication network, broker, the broker acts as a neutral intermediary. You place a buy order for the euro to US dollar pair. The broker takes that order and instantly passes it on to a liquidity provider, a major bank like JP Morgan, UBS, or Deutsche Bank. The bank takes the other side of the trade. The broker makes their money by charging you a commission or a small markup on the spread. They do not care if you win or lose. They only care that you continue to trade so they can keep collecting commissions. In this environment, your interests are aligned. If you are profitable, you survive longer, trade more, and generate more revenue for the broker. This is the ideal environment for a legitimate algorithmic strategy. However, the vast majority of heavily advertised, unregulated, or offshore brokers operate on the B-book model. In this scenario, your trade never leaves the broker's internal system. You place a buy order. The broker takes the sell side. They become the counterparty to your trade. They are betting directly against you. If you make $100, the broker loses $100. If you lose $1,000, the broker keeps that $1,000 as pure profit. This creates a fundamental, irreconcilable conflict of interest. Because 90% of retail traders lose money eventually, the B-book model is incredibly lucrative for brokers. They are essentially running a casino where the house edge is the trader's own lack of skill. But here is where it gets dangerous for your AI robot. If you are a manual trader losing money on your own, the broker is happy to leave you alone. But if you install a high-frequency trading bot or a scalping algorithm that actually starts to win, or even just generates too much volume, you become a liability to the B-book broker. You are now taking money directly out of their pocket. This is when the dirty tricks department gets involved, often utilizing sophisticated back-end software plugins, historically referred to as virtual dealer plugins. These plugins allow the broker to manipulate the execution of your trades in subtle ways that are almost impossible to prove, but devastating to a sensitive algorithm. The first tool in their arsenal is artificial latency. Your robot sends a signal to buy at 1.0500. The market is moving fast. A legitimate execution takes milliseconds, but the broker's plugin can introduce a deliberate delay of, say, 200 milliseconds. In that fraction of a second, the price moves to 1.0502. The broker fills you at the new worst price. This is slippage. For a human swing trader targeting 100 pips, losing 2 pips is negligible. But for an AI scalper targeting 5 pips, a 2-pip slip erases 40% of the potential profit margin instantly. Over hundreds of trades, this artificial friction turns a winning mathematical edge into a losing system. The second tool is asymmetric slippage. You will notice that when the market moves in your favor, you rarely get a better price, positive slippage. The broker pockets that difference. But when the market moves against you, you always get the worst price, negative slippage. This destroys the probability distribution that your AI was trained on. The third tool is spread widening. During moments of volatility, or sometimes for no reason at all during low liquidity hours like the Asian session rollover, the broker can widen the spread, the difference between the buy and sell price, by 5 or 10 times the normal amount. If your robot relies on tight stops, this artificial widening triggers your stop loss, closing you out of the trade even if the actual market price never touched your level. This is often called stop hunting, though technically it is just liquidity manipulation. This brings us to the free commission trap. You have likely seen brokers advertising zero commission trading. If a business provides a complex service involving servers, data feeds, and staff, how can they offer it for free? The answer is they do not. They bake the cost into the spread. Instead of a tight 0.1 pip spread and a fixed commission, they give you a 1.5 pip spread. For a high-frequency robot that trades 10 times a day, that extra spread cost is exorbitant. It is a hidden tax that bleeds the account dry. A robot backtested on raw spreads with commission will show a profit. That same robot running on a zero commission account with marked up spreads will show a loss, simply because the transaction costs exceed the average profit per trade. So why do robot developers recommend these B-book brokers? Why do you see a specific broker's banner ad right next to the Download Now button for the bot? This is the dark underbelly of the affiliate marketing ecosystem. These developers are rarely making their money from trading. They are making money as introducing brokers, IBs. The broker pays the developer a commission for every client they refer. But the structure of these commissions is telling. Often the developer gets paid a rebate on every lot you trade. This incentivizes the developer to build robots that overtrade. They create churning bots, systems that open and close hundreds of tiny trades with zero real logic, just to generate volume. The developer gets paid their rebate every time the bot executes, regardless of whether you win or lose. In fact, under some CPA cost per acquisition models, the developer gets a bonus if you deposit large amounts, knowing full well you will lose it on the B-book execution. You are entering an arena where the stadium owner, the referee, and the opposing team are all working together against you. The robot you bought is often just a tool to generate commission for the seller and deposit losses for the broker. This does not mean profitable trading is impossible, but it means you must demand an A-book, ECN environment with raw spreads and transparent commissions. You must verify the broker's regulation. A broker regulated by the CFTC in the US, the FCA in the UK, or ASIC in Australia, is under strict surveillance. They are required to segregate client funds and, in many cases, report trade execution data. A broker registered on a tiny island nation with a PO box is accountable to no one. Now let's assume you navigate this minefield. You find a legitimate ECN broker. You have a robot that is not a grid system. You have realistic expectations. You are ready to trade. But there is one specific category of strategy that is marketed more aggressively than any other, appealing to our desire for speed and instant gratification. It is the strategy that promises to steal tiny profits from the market in seconds, claiming to be immune to long-term trends. I am talking about high-frequency scalping and tick scalping. It sounds sophisticated, sounds like what the banks do, but in the retail environment, it is almost always a lie based on a misunderstanding of market physics. In the next part of this masterclass, we are going to dismantle the myth of the retail scalper. We will look at why the speed of your internet connection, the geographic location of your VPS, and the tick data limitations of MetaTrader make true high-frequency trading physically impossible for the retail trader. We are going to explain why those bots that claim to make money in seconds are actually just exploiting demo feed glitches that disappear the moment real money is on the table. You are about to learn why speed kills. Let's talk about the physics of the market. Not the economics, but the actual physical reality of how data moves through fiber optic cables underneath the Atlantic Ocean. When a vendor sells you a high-frequency scalping robot, they are selling you a fantasy that defies the laws of physics for a retail trader. They claim their bot can snatch 5, 10, or 20 trades in a minute, capturing micro-movements of price that the human eye cannot even register. They call it sniping. But in the world of institutional finance, this is like bringing a plastic spoon to a gunfight against a laser-guided missile system. To understand why speed is a trap for the retail trader, you have to understand where the market actually lives. The foreign exchange market is not a cloud. It is physically located in massive data centers, primarily the New York 4 data center in Secaucus, New Jersey, and the LD4 data center in London. The major banks, hedge funds, and high-frequency trading, HFT firms pay millions of dollars a year to place their servers literally feet away from the exchange's matching engine. This is called co-location. The length of the cable connecting their server to the exchange is measured in meters. Their trade execution time is measured in microseconds, millionths of a second. Now imagine your setup. You are running a super scalper AI on your home Wi-Fi in Ohio, or even on a $20 a month virtual private server VPS, in a shared data center in Amsterdam. The signal has to travel from the exchange to your broker's bridge, to your VPS, process through the clunky MetaTrader software, generate a signal, and travel all the way back. That round trip takes perhaps 50 to 200 milliseconds. To you, that is instant. To an HFT algorithm, 200 milliseconds is an eternity. It is enough time for the market to change direction, for the liquidity to vanish, and for the price you wanted to disappear. By the time your robots by order arrives, the HFT firms have already bought that price, marked it up, and are selling it back to you at a loss. You are eating their exhaust fumes. This latency disadvantage leads to a phenomenon known as toxic flow. If your retail bot somehow manages to be fast enough to pick off a stale price, a price that hasn't updated yet on a slow broker feed, the liquidity provider, the bank on the other end, will notice. Banks have a mechanism called last look. When you try to trade with them, they get a fraction of a second to look at your order and decide if they want to fill it. If your bot is trying to exploit a lag in the price, the bank simply rejects the trade. You get a requote or off-quotes error. Your bot spams the server with orders, the broker sees you are generating error logs, and they shut down your account. The strategy works in theory, but the infrastructure of the market is designed to reject it. But the deception of the scalping bot goes deeper than just execution speed. It is rooted in the data itself. Most retail traders backtest their robots on 1-minute M1 data. A 1-minute candle has 4 data points: open, high, low, and close. That is it. But inside that 1 minute, the price might have ticked up and down 300 times. A scalping bot lives in those ticks. When you run a standard backtest, the software interpolates. It guesses what happened inside that minute. It creates a simulated path of price that is smooth and logical. In this simulation, the price moves nicely from A to B. The bot buys the dip and sells the rip. It makes a fortune. But in real life, price does not move smoothly. It gaps, jumps. It is fractal and chaotic. The tick data you test on is a clean map. The live market is a swamp. If you are not testing on 99.9% quality tick data, which requires gigabytes of paid historical files and specialized software, your backtest is a hallucination. You are testing a strategy on a market that never existed. I have seen bots that turn $100 into $10 million on standard M1 data, only to lose everything in 2 hours on real tick data because the microtrends it was exploiting were just artifacts of the simulation engine. Let's examine the most popular subcategory of these failed scalpers, the Asian Session Night Scalper. This is a classic trap. The theory is sound. Between 5 p.m. and 5 a.m. New York time, the US and European markets are closed. The market is quiet. Pairs like euro to US dollar or pound sterling to US dollar tend to move sideways in a tight range. The robot is programmed to buy at the bottom of the range and sell at the top. On a backtest, this looks like a straight line of profit. It wins thousands of tiny trades. However, there is a catch that the backtest ignores: rollover. At 5 p.m. New York time, the banking day ends. For a few minutes, liquidity completely evaporates as the banks reset their systems for the next day. During this window, spreads, the cost of trading, explode. A spread that is normally 1 pip can widen to 10, 20, or even 50 pips in a blink. The night scalper relies on making 3 to 5 pips of profit per trade. If the spread widens to 10 pips, the trade opens at a massive loss instantly. Worse, many of these bots hold trades open through the rollover. You might be floating a small loss of 2 pips. The clock strikes 5 p.m. The spread widens. Your ask price shoots up, triggering your stop loss. The trade is closed at the worst possible price of the day. Then, 1 minute later, the spread normalizes and the price goes back to where it was. The market didn't move. The spread just breathed. But your account is dead. The backtest did not account for variable spreads. It assumed a fixed spread of 1 or 2 pips. In the live market, the Asian session is not a calm river. It is a minefield of variable costs that destroys small target strategies. Imagine you are trying to pick up coins from the middle of a highway. The night scalper assumes the highway is empty at 3 a.m. And usually it is. But every once in a while, a convoy of trucks, news events, or liquidity voids comes through at 100 miles per hour. The robot doesn't look for trucks. It only looks for coins. It is a strategy with negative skew. Frequent small wins and occasional massive, fatal losses. This leads us to the ultimate limitation of the tick scalper. The barrier of entry is not code. It is capitalization and infrastructure. The firms that successfully scalp the market are not using MetaTrader 4. They are using C++ algorithms running on FPGA, field programmable gate array hardware, which processes data on the chip itself to save nanoseconds. They are paying $50,000 a month for data feeds that include the Level 2 order book, seeing the depth of buyers and sellers, not just the current price. Your $200 bot is blind to this data. It is trying to predict the direction of a crowd without seeing the crowd. It is reacting to the price after the price has already moved. In a game of speed, reaction is failure. Prediction is power. But prediction requires data that you do not have. So, if the grid bots blow up and the scalpers die by the spread, what is left? The marketing teams behind these robots know that the retail public is catching on to the scalping buzzword being dangerous. So they have pivoted. They have adopted a new, sexier narrative. They are now selling you trend following and price action bots. They claim to replicate the mind of a human trader, identifying support and resistance, drawing trend lines and reading candle patterns. They tell you, this isn't a risky scalper, this is a swing trader. But this introduces a far more complex problem. A computer can calculate a moving average in a nanosecond. But can a computer see a chart? Can a script differentiate between a legitimate breakout and a fakeout, caused by a rumored tweet from a central banker? The answer lies in the fundamental flaw of trying to code human intuition into a rigid syntax. We are about to cross the bridge from hard math failures to soft logic failures. In the next part, we are going to dive into the price action paradox. We will explore why AI struggles to identify simple patterns that a human child can see, why support and resistance is invisible to a robot, and how the chaotic emotional nature of the market breaks the logic of even the most sophisticated trend-following algorithms. You are about to learn why the most powerful computer in the world still cannot beat a disciplined human mind at reading context. To the average retail trader, a price chart is a story. You look at the candlesticks and you see a narrative. The buyers are exhausting, the sellers are stepping in, the momentum is stalling at a key psychological level like 1.2000. You see a head and shoulders pattern forming, or a double bottom. Your brain, which has evolved over millions of years to recognize patterns in chaos, like a predator hiding in the grass, can instantly synthesize complex visual data into a gut feeling or a strategic bias. You understand context. You know that a breakout happening at 2 p.m. on a Friday during a bank holiday is likely fake. You know that a sudden drop caused by a fat finger error is different from a drop caused by a declaration of war. The robot does not see the story. The robot sees a stream of floating point numbers. It sees open, 1.0501, high 1.0505, low 1.0490, close 1.0500. It does not see a double bottom. It sees a mathematical array where the variable low is approximately equal to low. This leads us to the price action paradox. The more you try to code the fluidity of human discretion into a rigid algorithm, the less effective it becomes. We are taught that the trend is your friend, but for a robot, identifying the trend in real time without lagging indicators is a computational nightmare that results in the single biggest killer of trend-following bots: the whipsaw. Let's walk through the anatomy of a breakout bot failure to understand this. A common strategy sold to beginners is the London breakout. The logic is simple. Identify the high and low price of the Asian session, and if the price breaks above the high, buy. If it breaks below the low, sell. Sounds foolproof. The market wakes up in London, volatility kicks in, and the price should pick a direction. Here is what happens in reality. The Asian high is at 1.0550. The bot has a buy stop order sitting at 1.0551. At 3 a.m. Eastern, the London banks come online. They see a cluster of liquidity, stop losses and buy orders, sitting right above 1.0550. They push the price up to 1.0555 to fill their own sell orders. Your bot triggers a buy, thinks the trend has started. But this was not a breakout, it was a stop hunt. The smart money was selling into the strength. Immediately after hitting 1.0555, the price reverses aggressively, crashing down to 1.0520. Your bot is now trapped at the absolute top of the wick. This is a fake out. A human trader might have waited. They might have looked for a retest of the level. They might have seen that the momentum on the lower timeframes was diverging. But the bot has no nuance. It has a binary trigger: if price level, then buy. To fix this, developers try to add filters. They say, only buy if the candle closes above the level. Okay, so the bot waits. A massive green candle closes at 1.0560. The bot buys. But because it waited for the close, it has entered the trade late. The move is already exhausted. The price retraces immediately, and the bot loses again. This is the catch-22 of algorithmic trend trading. Enter early and get faked out. Enter late and get stopped out. Furthermore, let's discuss the failure of support and resistance in code. To you, support is a zone. It is a fuzzy area between 1.0500 and 1.0510 where buyers tend to show up. To a computer, a number must be precise. If you code the bot to buy at 1.0500 and the price bounces at 1.0501, the bot misses the trade. If you tell the bot to use a buffer of 5 pips, it enters too early. The market is organic. Code is synthetic. The market breathes and expands based on volatility. A support level in a low volatility environment is tight. In a high volatility crash, support is a wide, chaotic zone. A hard-coded algorithm typically cannot adjust its definition of support dynamically enough to match the shifting psychology of the market participants. This brings us to the context blindness of AI. Imagine the euro to US dollar pair is dropping like a stone. The relative strength index, RSI, dips below 30, signaling oversold. A typical mean reversion bot sees this math and executes a buy, expecting a bounce. But why is the price dropping? If the price is dropping because of normal market fluctuations, the bounce will likely happen. But what if the price is dropping because the European Central Bank just announced an unexpected interest rate cut? The fundamental value of the euro has changed instantly. The oversold reading is irrelevant. The price is crashing to find a new equilibrium. The bot does not know the ECB president is speaking. It does not read the news ticker. It blindly buys the falling knife because the math said, oversold. Keeps buying all the way down, blowing up the account. This is why technical analysis bots fail during fundamental events. The math of the chart is subordinate to the reality of the economy. While some advanced hedge funds use natural language processing, NLP, to read news feeds and shut down their algos, the retail bot you bought for $49 definitely does not have access to a Bloomberg Terminal newsfeed API. It is trading in a vacuum, completely deaf to the roaring thunder of the macroeconomic landscape. We also have to talk about the fractal nature of the markets and how it confuses simple logic. A trend on the 5-minute chart might be an uptrend while the trend on the 1-hour chart is a downtrend, and the trend on the daily chart is sideways. A human trader aligns these timeframes, looking for confluence. They might decide, I will only buy if the 5-minute, 1-hour, and 4-hour trends align. Coding this multi-timeframe analysis is possible, but it results in a system that rarely trades. By the time all 3 timeframes agree, the move is usually over. If you loosen the rules, you get false signals. If you tighten the rules, you get analysis paralysis. The bot sits there for weeks doing nothing, and you, the user, get impatient. You think it's broken. You tweak the settings to make it more sensitive. Immediately, you introduce noise and the bot starts losing. The patience required for legitimate trend following is psychologically difficult for a human, but it is technically difficult for a bot, because a bot cannot distinguish between the market is quiet and the market is dead. So if rigid logic fails, the industry has a new buzzword to sell you: neural networks. They tell you, this isn't an if-then script. This is a black box that thinks like a human brain. They claim it uses deep learning to recognize patterns that are invisible to the naked eye. And this is where the deception moves from simple incompetence to sophisticated pseudoscience. True machine learning requires massive datasets to train. In image recognition, you show a neural network 10 million pictures of a cat, and eventually it learns what a cat looks like. It works because a cat always looks like a cat. A cat doesn't morph into a dog depending on the interest rate. But financial market data is non-stationary. The statistical properties of the market change over time. The patterns that worked in 2010 do not work in 2024. If you train a neural network on data from 2010 to 2020, you have trained it to recognize a specific species of market, a low-inflation, quantitative easing bull market. When you release that trained brain into the wild of 2025, a high-inflation, geopolitical conflict-ridden market, it is like releasing a penguin into the Sahara Desert. It is perfectly evolved for an environment that no longer exists. The AI is not intelligent. It is just highly specialized in predicting the past. It will confidently predict a bounce because that is what happened in the training data, unaware that the rules of the game have fundamentally changed. This leads us to the most terrifying aspect of true AI in finance: the black box problem. If a simple grid bot loses money, we can look at the code and say, it kept buying when it should have stopped. We can fix the logic. But with a deep learning model, even the developers do not know why it made a decision. It is a web of millions of weighted connections. If it starts losing money, you cannot fix it because you don't know what it is thinking. You are trusting your capital to an opaque mathematical entity that might be hallucinating correlations that don't exist. We have now debunked the grid systems, the scalpers, and the trend followers. We have exposed the limitations of simple code and the dangers of complex machine learning. But there is one final frontier of the robot market. It is the most exclusive, the most expensive, and the most dangerous of them all. It is the world of copy trading and PMM accounts. They tell you, don't buy the robot, just copy the master account running the robot. It sounds like the ultimate solution. Let the expert handle it. But what they don't tell you is that the master account is often rigged to win, while the slave accounts are mathematically destined to lose due to a hidden force called latency arbitrage. In the next part, we are going to uncover the social trading scam. We will explain how a master trader can show a profit while every single person copying them loses money, and why the performance fee model is designed to incentivize high-risk gambling with your money. You are about to learn why following the leader is often just a quicker way to walk off a cliff. It sounds like the ultimate cheat code. You don't need to learn to code Python. You don't need to stare at charts for 10 hours a day. You don't even need to install a robot on a VPS. You simply click a button that says copy, and your account mirrors the trades of a master trader, a supposed genius who has cracked the market. This is the world of social trading, PAMM, percent allocation management module, and MAM, multi-account manager systems. It is marketed as the democratization of hedge fund strategies. But in reality, it is often a slaughterhouse designed to funnel capital from the uninformed many to the unscrupulous few, using a mechanism that exploits the physical limitations of the internet itself. Let's start with the technical killer that ruins most copy trading ventures before they even begin: latency arbitrage. In a copy trading setup, there is a master account and a slave account, yours. When the master places a trade, a signal must be generated, sent to the broker's server, processed, and then broadcast out to hundreds or thousands of slave accounts. Your terminal then receives that signal and sends a request back to the broker to open the trade. This process takes time. It might be 300 milliseconds, it might be 2 seconds. Now, imagine the master is using a high-frequency scalping robot, the kind we discussed earlier, that targets a profit of just 3 or 4 pips. The master buys euro to US dollar at 1.1000. The price is moving fast. By the time your account receives the signal and executes the trade, the price has already jumped to 1.1002 due to the buying pressure from the master and the other faster slaves. You have entered 2 pips worse than the master. 5 minutes later, the master closes the trade at 1.1004. He banks a 4-pip profit. The close signal is sent. By the time you close, the price might have slipped back to 1.1003. You made 1 pip. Or worse, the price reversed and you lost money. On the leaderboard, the master shows a smooth, upward-sloping equity curve with hundreds of winning trades. On your account statement, you see a jagged, declining line full of losses or break-even trades. You are scratching your head, wondering how it is possible to lose money while copying a winner. The answer is that you are not copying his execution. You are only copying his intent. In the ruthless environment of intraday Forex trading, intent is worthless without precision. The only people who make money in a scalping PMM are the master, who gets the best price, and the broker, who collects the commission from everyone. The slaves are simply providing the liquidity that pushes the price in the master's favor. But the technical lag is just the tip of the iceberg. The deeper rot lies in the financial incentives of the performance fee model. Typically, a PMM manager charges a success fee of 20 to 30% of the profits they generate for you. This sounds fair. I only get paid if you make money. But this structure creates a perverse incentive known in economics as the call option payoff profile. Let's simulate a scenario. A rogue trader opens a PMM account. He knows that to attract millions of dollars in capital, he needs to show a massive return quickly. He does not care about risk management, he cares about the leaderboard. He employs a hyper-aggressive martingale strategy. He risks 50% of the account to make 100%. If he gets lucky and the account doubles, he takes his 30% cut of the profits, which on $1 million pool is $300,000 in his pocket. If he gets unlucky and the account blows up to 0, he loses nothing. He loses $0 of his own money because he was trading your capital. He has infinite upside and capped downside 0. You, the investor, have capped upside minus the fee, and infinite downside, 100% loss. He is gambling with your chips. If he wins, he buys a Ferrari. If he loses, he deletes the Telegram channel, changes his username and starts over. This is why you see PMM accounts that skyrocket by 5,000% in 2 months and then vanish off the face of the earth in a single day. The manager was never trying to build a sustainable fund. He was trying to hit a jackpot with your money before the inevitable crash. This leads to the infinite monkey manufacturing process of these gurus. How do these platforms always have new top-ranking traders with amazing stats? It is simple probability. Imagine a guru factory. A group of scammers opens 100 different trading accounts. On 50 of them, they go long euro to US dollar. On the other 50, they go short. The market moves. 50 accounts blow up. They are deleted and hidden from the public history. The remaining 50 are now up 100%. They repeat the process. 25 go long, 25 go short. Half blow up. Now they have 25 accounts that are up 300%. They do this 4 or 5 times until they have 1 or 2 survivor accounts that have won 5 aggressive trades in a row and are up 2,000%. They rename this account Titan or Forex_V3, verify it on MIFSpook, and open it to the public for copying. You, the unsuspecting retail investor, look at the chart. You see a genius who has never lost a trade. You pour your savings in, but you are not looking at skill. You are looking at the lucky survivor of a coin-flipping tournament. The moment you invest, the statistical probability catches up. The next trade is a 50-50 coin flip, and since there is no real strategy, the account eventually blows up. The scammer walks away with the performance fees earned during the brief period of luck, and the guru factory starts the process all over again with fresh accounts. There is also a more insidious version of this called churning or rebate farming. Many brokers pay the master a commission for every lot traded by their followers. This is often hidden in the fine print. The master might earn $5 per lot. If he has 500 followers, a single trade executes hundreds of lots in total volume. That is thousands of dollars in instant commission for the master, win or lose. So what does the master do? He installs a robot that opens and closes trades rapidly, all day long. The trades might just break even or take small losses. The master doesn't care about the profit from the trade. He cares about the volume. He is churning your account to generate rebate commissions for himself. You see your account slowly bleeding out from spreads and commissions, while the master is making a fortune on the back-end rebates. By the time you realize what is happening and disconnect, he has already drained 10 or 20% of your equity in useless transaction costs. Furthermore, we must address the liquidity ceiling. Even if you find a legitimate master, a rare trader who actually has an edge and trades ethically, copy trading eventually kills the strategy itself. Every strategy has a capacity limit. A strategy that works with $10,000 might fail with $10 million. Imagine a master who trades the Asian range breakout on the pound sterling to US dollar pair. There is only so much liquidity available at that time of night. If he is trading his own money, he gets filled easily. But if he has 5,000 followers and a total pool of $50 million copying him, his order becomes a market-moving event. When the signal fires, $50 million tries to buy pound sterling to US dollar at the same second. There are not enough sellers. The price explodes upward purely because of the copy volume. The slaves at the front of the queue get filled. The slaves at the back get filled 20 pips higher. Then, when the master tries to sell to take profit, the same thing happens in reverse. The sheer weight of the followers crushes the edge. The master realizes his strategy no longer works because he is too big, so he closes the PMM. But usually he doesn't close it in time. He tries to force the trades, and the slippage drag turns a winning system into a loser for everyone involved. The ecosystem of social trading is designed to appeal to our laziness. It preys on the belief that we can ride on the shoulders of giants without risk. But in the financial markets, nobody gives away a true edge for free. If a trader had a system that could genuinely turn thousands into millions with low risk, they would be trading proprietary capital for a family office or a hedge fund, under strict non-disclosure agreements. They would not be sharing their signals on a public app for a $20 subscription fee or a performance cut from a $500 retail account. The fact that they are selling the signal is proof that the signal itself is not the primary source of their income. You are. We have now systematically dismantled the robots, the grid systems, the scalpers, and the copy trading platforms. It seems like everywhere you turn there is a trap. So, what if you decide to step away from the automation entirely? What if you decide, I will learn to trade myself? I will find a mentor. I will join a VIP signal group where a real human analyzes the market and tells me what to do. Surely human mentorship is the answer? Surely there are honest educators who just want to help you learn? Unfortunately, you are about to walk into the most psychologically manipulative sector of the entire industry. The signals service and fake guru economy is not built on code. It is built on cult-like persuasion tactics and rented lifestyles. In the next part, we are going to expose the signal room racket. We will show you how they fake their results in Telegram channels using the edit feature, how they use demo magic to rent Lamborghinis for Instagram Reels, and why the inner circle you are paying for is often just a group of other losing traders echoing the same bad advice. You are about to learn how to spot a fake mentor before they steal not just your money, but your time. You finally decide that automation is the problem. You tell yourself that a machine cannot understand the market, but a human can. You scroll through Instagram or TikTok and you find him, the mentor. He is young, he is confident, and he is standing in front of a matte black supercar, holding a stack of cash. He posts stories of charts with massive sniper entries and captions like "Another day, another 500 pips. Join the VIP for free." You think to yourself, this guy has obviously cracked the code. He is living the life you want. Why wouldn't you listen to him? So, you click the link in his bio and join his free Telegram channel. You have just walked into one of the most psychologically sophisticated traps in the financial industry, the signal room racket. The first thing you need to understand is that the lifestyle you are seeing is almost certainly a rented stage prop. There is an entire cottage industry in places like Miami, Dubai, and London dedicated to renting wealth assets to fake gurus for photo shoots. That Lamborghini Huracan? It costs $1,000 to rent for the day. That penthouse apartment with the view? It is an Airbnb booked for a weekend to shoot 6 months worth of content. The stack of cash? It might be real, but it is likely the entirety of their marketing budget withdrawn from the bank just for the video, or worse, prop money bought online for $50. You are not looking at the results of trading success. You are looking at a marketing funnel designed to bypass your critical thinking and target your greed. If they were truly making millions trading, they would be trading, not filming TikTok dances pointing at buy signals. Once you are inside the free Telegram channel, the manipulation begins. You see a stream of winning trades. Green check marks everywhere. T1 hit. TP2 hit. 100 pips banked. It looks incredible. But you are missing the sleight of hand. Telegram, unlike a regulated trading statement, has a feature that is the scammer's best friend: the edit button and the delete button. Here is the classic ghost signal trick. The guru posts a vague message. Watch euro to US dollar. No specific entry, no stop loss. Just watch. If the price goes up, he edits the message to say buy euro to US dollar now, and posts a screenshot of the chart claiming he called the move. If the price goes down, he edits it to sell euro to US dollar now, or simply deletes the post entirely. If you are not watching the channel 24/7, you only see the survivors. You scroll up and see a history of perfection. You do not see the graveyard of deleted predictions. Even more insidious is the hedge scam. The guru has 2 free channels. Let's call them Alpha Group and Beta Group. You are an alpha. He tells you buy gold. He tells the beta group sell gold. The market moves. One group loses and gets angry. He kicks them out or ignores them. The other group wins and thinks he is a god. He then upsells the winning group to his VIP lifetime membership for $500. He churns through thousands of people this way, always maintaining a pool of winners who provide him with the testimonials he needs to hook the next batch. But the most common model is the free VIP access via a broker affiliate link. He tells you the VIP signals are normally $100 a month, but you can get them for free if you sign up to his partner broker and deposit $500. This sounds like a great deal. You keep your money, you get the signals. But remember the B-book concept we discussed earlier? The guru is often on a CPA, cost per acquisition, or a net loss revenue share deal with that broker. If he is on a revenue share, he literally gets a percentage of your losses. Think about that. The person telling you what to buy gets paid when you lose. Do you think he is sending you high probability setups? Or is he sending you high risk, over-leveraged gambling calls designed to blow your account so he can collect his 40% cut of your deposit? He is not your mentor. He is the broker's acquisition agent. You are the product. Let's assume you ignore the red flags and take the signals. You are now facing the execution gap. The guru posts, Buy pound sterling to Japanese yen now at 160.50. You see the notification on your phone. You unlock it, open your MetaTrader app, find the pair and click buy. That process took 10 seconds. In those 10 seconds, the price has moved to 160.65. You are buying late. You are chasing the price. Then the price reverses to 160.40. The guru posts stop loss hit minus 10 pips. But because you entered late, your loss is 25 pips. Then he posts re-entry. Buy now. You buy again. The price chops around. You are confused. You ask in the chat if chat is even enabled. What do I do? No answer. Then 3 hours later the price spikes up. The guru posts he hit. Plus 50 pips. We are eating good tonight, family. But you? You got stopped out twice on the volatility and missed the final move because you were too scared to re-enter. The guru claims a win. You have a loss on your account. This discrepancy between the signal record and user reality is why signal services rarely work for the subscriber. You are outsourcing your brain to someone else, but you cannot outsource the execution risk. Furthermore, these groups often function as echo chambers that reinforce bad habits. When a trade goes wrong, the guru never admits fault. It is always market manipulation, or the banks are stop hunting. He gaslights you into believing that the analysis was perfect, but the market was wrong. This prevents you from learning. You start to believe that trading is rigged and that the only way to win is to follow the guru even harder. Creates a cult-like dependency. You stop analyzing charts yourself. You become paralyzed without a notification. You are not a trader. You are a remote-controlled clicker for someone else's ego. We also need to talk about the risk-to-reward mathematical lie used in these channels. You will often see signals with a massive stop loss and a tiny take profit. For example, buy US 30, SL 100 points, TP 20 points. This signal has a high probability of hitting the take profit simply because the target is so close. The guru can claim a 90% win rate. But look at the math. You win 9 trades and make 180 points total, 9 by 20. Then you lose 1 trade and lose 100 points. Your net profit is small, but usually it is worse. The guru uses martingale signals. If a signal loses, the next signal suggests doubling the lot size to recover. Recovery trade. Go heavy, he shouts. You double your risk. If that one loses, you are down 20% of your account in a single morning. A legitimate mentor teaches you to protect capital. A fake guru teaches you to chase losses because he needs you to feel the dopamine rush of a win to keep you subscribed. He is selling excitement, not consistency. The toxicity of this environment extends to the inner circle upsells. Once you are in the VIP, they will tell you that the real secrets are in the mentorship or mastermind group, which costs $5,000. They invite you to a flashy webinar. They use high-pressure sales tactics. Only 5 spots left. Price increases tomorrow. They prey on your desperation. You have lost money on the robots, lost money on the copy trading, and lost money on the VIP signals. You are desperate to make it back. You think, maybe the $5,000 course has the missing piece. So you pay. And what do you get? Usually, a series of pre-recorded videos covering basic support and resistance, recycled content you could find on YouTube for free, and access to a Discord server full of other struggling traders who are just as confused as you are. It is the blind leading the blind, orchestrated by a man who makes his money selling the map, not walking the path. At this point, you might feel hopeless. We have debunked the AI bots that promise passive income. We have exposed the rigged game of B-book brokers. We have torn down the myth of the scalping algorithm. And now we have revealed the fake gurus and their signal room scams. It seems like every door leads to a trap. It seems like the entire retail trading industry is designed to extract money from you, not for you. And you would be right. 95% of the industry is a trap. But that leaves 5%. There is a way to trade. There is a way to use technology. But it looks nothing like the hype you have been sold. It is not passive. It is not easy. And it definitely doesn't involve a Lamborghini. Real trading is closer to running a boring, risk-averse insurance company than it is to gambling at a casino. It involves understanding probability, managing downside, and accepting that AI is a tool for analysis, not a magic wand for profit. We need to strip away the fantasy and rebuild your understanding of the market from the ground up, using the principles that actual professional proprietary traders and quantitative analysts use. In the next part, we are going to pivot from exposing the lies to revealing the hard truth of what works. We are going to discuss the quant approach. I am going to show you how to build a portfolio of systems that actually make sense. We will talk about expected value, correlation, and why your goal should be to be the casino, not the gambler. We are done with the scams. Now we start the real education. Welcome to the other side of the looking glass. We have spent the last 8 videos tearing down the illusions of the retail trading industry. We have burned the fake gurus' rented supercar, we have dismantled the black box grid bot, and we have exposed the brokers' rigged casino tables. Now we are standing in the wreckage. If 99% of what you see is a lie, what does the remaining 1% look like? What is the truth? The truth is that legitimate algorithmic trading exists, but it is not a get-rich-quick scheme. It is a business of probability management. To survive in this arena, you must undergo a fundamental identity shift. You must stop thinking like a gambler trying to beat the house, and start thinking like the house itself. Consider the business model of a casino, specifically the roulette wheel. On a standard American wheel, there are numbers 1 through 36, plus a 0 and a 00. That is 38 total slots. If you bet on red, you are betting on 18 numbers. Your probability of winning is 18 divided by 38, or roughly 47.3%. The probability of the casino winning is 52.7%. That tiny gap, that 5.4% difference, is the house edge. The casino does not know if they will win the next spin. They do not care. They know that over 1 million spins, the law of large numbers guarantees they will capture exactly 5.4% of all the money wagered. They do not need to predict the future. They only need to rely on the math. Your goal as an algorithmic trader is to become the casino. You are not looking for a robot that knows where the price is going. You are looking for a system with a positive expected value, EV. This is the single most important formula in trading, yet almost no retail robot seller mentions it. Expected value is calculated as percentage of wins multiplied by average win size minus percentage of losses multiplied by average loss size. Let's run the numbers on 2 hypothetical systems to prove why win rate is a vanity metric. System A is the typical scam bot we discussed. It has a 90% win rate. It makes $10 on a win, but on the 10% of trades where it loses $100 because it has no stop loss. The EV calculation is open parenthesis 0.90 times 10 close parenthesis minus open parenthesis 0.10 times 100 close parenthesis. That is $9 minus $10. The result is negative $1. For every trade you take, you are mathematically losing $1, even though you win 90% of the time. You are bleeding to death while feeling like a winner. Now look at System B, a professional trend-following strategy. It has a win rate of only 40%. It loses more often than it wins, but its winners are huge. It makes $200 on a win and loses $100 on a loss. The math. Open parenthesis 0.40 times 200 close parenthesis minus open parenthesis 0.60 times 100 close parenthesis. That is $80 minus $60. The result is positive $20. This system loses 6 out of 10 times, but for every trade executed, it prints $20 of theoretical profit. A professional quant trader will take System B every single day of the week, while the amateur will reject it because it feels bad to lose that often. This is the psychological barrier you must break. You must fall in love with losing correctly so you can win sustainably. Once you have a system with a positive EV, the next challenge is variance and the risk of ruin. Even a casino can go bankrupt if a billionaire walks in and bets the entire vault on a single spin of red. If red hits, the casino is finished. This is why table limits exist. In trading, your table limit is your position size. A legitimate strategy with a positive edge will still experience drawdown periods, sequences of losing trades. You might lose 5, 10, or even 15 trades in a row. This is statistically normal. If you are risking 5% of your account per trade, a 10-trade losing streak wipes out 50% of your capital. To get back to break-even from a 50% loss, you need to make a 100% gain. That is mathematically incredibly difficult. However, if you risk 0.5% or 1% per trade, that same losing streak only draws you down 5% to 10%. Recovering from a 10% loss requires an 11% gain. That is manageable. The AI robots that blow up accounts do so because they ignore this. They bet 10%, 20%, or use leverage that effectively bets 100% of the account on a grid structure. The professional protects the downside at all costs because they know that as long as they have chips, the positive EV will eventually pull them into profit over the long run. This brings us to the concept of correlation and portfolio theory. Most retail traders think they are diversified because they are running a robot on euro to US dollar, pound sterling to US dollar, and Australian dollar to US dollar. They are not. They are trading the exact same driver, the US dollar. If the Federal Reserve makes a surprise announcement that spikes the value of the dollar, all three of those pairs will drop simultaneously. You don't have three trades, you have one giant trade leveraged 3 times. A true quantitative approach involves building a portfolio of uncorrelated strategies. Imagine you have one bot that trades momentum on gold, XAU/USD. You have another bot that trades mean reversion on the Euro-Swiss franc, Euro to Swiss franc. You have a third bot that trades seasonality on wheat futures. These 3 assets have very little to do with each other. If gold crashes, it doesn't necessarily mean wheat will move. By combining these into a portfolio, you smooth out the equity curve. When one strategy is in a drawdown, the others might be hitting new highs. This is the holy grail. It isn't one perfect robot. It is a team of imperfect robots that cover each other's weaknesses. You need to adjust your expectations of what success looks like. The internet has warped your brain to think that 10% a month is slow. Let's look at the best hedge fund of all time. The Medallion Fund by Renaissance Technologies. They are the kings of AI and machine learning. Their annualized return before fees is roughly 66%. That is amazing, but that is per year. If the smartest mathematicians in the world with supercomputers and exclusive data are making 4 to 5% a month on average, why do you think a $49 robot can make 50% a month? A realistic target for a retail algorithmic portfolio is perhaps 20% to 40% per year, with a maximum drawdown of 10% to 15%. That might sound boring. It might not buy a Lamborghini next week. But if you compound 30% a year for 20 years, you build generational wealth. If you chase 30% a month, you go broke in 3 months. The choice is between being a get-rich-quick gambler who stays poor, or a get-rich-slow business owner who eventually becomes wealthy. So, how do you actually implement this? You stop buying compiled.x4 files from strangers on Telegram. You start learning to backtest properly. You learn a coding language like Python or MQL5, or you use no-code strategy builders that allow you to construct logic without writing script. You define your hypothesis. I believe that when the London market opens, there is a volatility expansion. You build a rule set. You test it on 10 years of data. You look at the max drawdown. You stress test it with Monte Carlo simulations, randomizing the trade order to see if the system breaks. You then run it on a demo account for 3 months. If it survives, you put it on a live account with the smallest possible lot size. You treat it like an R&D experiment. You monitor the slippage. You record the execution speed. You are data mining your own performance. This is work. It is not passive income. It is active management of automated systems. The robot does the execution, but you are the risk manager. You are the CEO of your trading desk. We have covered the scams, the technical traps, the psychological pitfalls, and now the mathematical reality. You are likely left with one burning question. Is it even worth it? If the edge is so small, and the work is so hard, and the competition is so fierce, is there a future for the retail trader in the age of AI? The answer is yes, but not in the way you think. The landscape is shifting beneath our feet right now. Generative AI and large language models are changing the game, but they are also opening a new door that was previously locked to everyone except the institutions. In the final part of this masterclass, we are going to look at the future. I am going to give you the final verdict on whether you should pursue this path. We will discuss how LLMs like ChatGPT can actually assist in coding legitimate strategies, how alternative data is becoming accessible to retail, and I will give you a concrete, step-by-step roadmap for your next 12 months if you choose to take this journey seriously. We are going to land the plane. Part 10 is the conclusion. So, is the age of the retail trader over? Have the institutions, armed with their billion-dollar supercomputers and fiber optic cables, finally closed the door on the little guy? The answer is nuanced. The era of dumb retail trading, the era of buying a random moving average crossover bot and hoping for the best, is absolutely dead. It has been dead since 2012. But the era of the retail quant is just beginning. We are standing at the precipice of a technological democratization that is unprecedented in financial history. The tools that were once exclusively locked behind the doors of 2 Sigma and Citadel are slowly trickling down to your laptop. Let's talk about the elephant in the room. Generative AI and large language models like ChatGPT, Claude, and Llama. Most people are using these tools completely wrong. They ask the AI, predict the price of Bitcoin for next week. The AI hallucinates an answer, the user bets money, and they lose. That is the oracle fallacy. LLMs are not crystal balls. They are language engines. They do not understand market mechanics or future liquidity flows. However, they are world-class junior programmers. Previously, if you wanted to build a portfolio of uncorrelated algorithmic strategies, you needed to be fluent in C++, Python, or MQL. You needed to understand syntax, memory management, and debugging. That barrier kept 90% of traders out of the game. Today, you can speak to an LLM in plain English. You can say, write a Python script using the Pandas library to backtest a mean reversion strategy on the euro to US dollar pair. Enter when the price deviates 2 standard deviations from the 20-period moving average, and exit when it returns to the mean. Include transaction costs of 2 pips per trade. The AI will generate the code for you. It will write the logic. It will not give you a winning strategy. That idea must come from your brain, from your observation of the market, but it removes the friction of implementation. It turns you from a coder into an architect. You no longer need to know how to lay the bricks. You just need to design the building. This is the true power of AI in 2025. It is a force multiplier for your intellect, not a replacement for it. Furthermore, we are seeing a shift from technical data to alternative data. For decades, retail robots only looked at price and volume. They were blind to the world. Institutions, meanwhile, were trading on satellite data, credit card transaction aggregations, and sentiment analysis. Now, APIs are becoming available to retail traders that allow you to feed sentiment into your logic. You can build a bot that only takes a buy trade if the technical trend is up and the aggregated news sentiment on the US dollar is negative. This is hybrid trading. It combines the speed of the robot with the contextual awareness of data streams that mimic human intuition. So, if you are ready to stop gambling and start building, what does the path actually look like? If you are willing to commit the next year of your life to this, not as a hobby, but as a second career, here is your 12-month roadmap. Months 1 through 3 are the deprogramming and education phase. During this time, you do not place a single trade. Not one. You delete the MetaTrader app from your phone. You stop following signal gurus on Instagram. Your job is to learn the language of the business. You need to learn the basics of Python for finance. You don't need to be a software engineer, but you need to understand how to handle data. You need to read books on quantitative finance, real books, not ebooks. Read Trading Systems and Methods by Perry Kaufman or Evidence-Based Technical Analysis by David Aronson. You need to understand the statistical difference between luck and edge. You need to learn what a Monte Carlo simulation is and why it matters. If you cannot explain degrees of freedom or in-sample versus out-of-sample testing, you are not allowed to open a brokerage account yet. Months 4 through 6 are the laboratory phase. This is where you start building. You use your new Python skills or a high-end strategy builder to test ideas. You will likely test 100 different ideas. 99 of them will fail. You will find a strategy that looks amazing, and then you will realize you made a coding error that looked into the future. You will fix it and the curve will flatten. This is good. You are learning to fail cheaply. You are failing in a simulation, not with your retirement fund. Your goal here is to find 1 or 2 simple, robust logics that survive across different market conditions. You are not looking for a 45-degree line. You are looking for a messy, jagged line that generally goes up over 10 years without crashing. Months 7 through 9 are the incubation phase. You have a code that works in the past. Now you need to see if it works in the future. You deploy your strategy on a demo account or a live account with the absolute minimum capital, literally risking pennies. You are testing the infrastructure. Does the bot disconnect when the VPS restarts? Does the spread widening at 5 p.m. kill the logic? Does the broker execute the trade at the price you expected? You are gathering forward data. This is psychologically the hardest part because you are doing a lot of work for zero money. You are acting as a scientist observing a specimen. Most people quit here because they get bored. They want the dopamine hit of the gamble. You must resist that urge. Months 10 through 12 are the live execution phase. If and only if your incubation data matches your backtest data, you start to scale. But you do not dump your savings in. You use fixed fractional position sizing. You decide to risk 0.5% of your account per trade. If the system performs well, the account grows, and that 0.5% becomes a larger dollar amount. If the system fails, the account shrinks and you risk less. You are now running a business. Your morning routine is not checking charts for setup. It is checking server logs to ensure uptime. You are a system administrator. You are a risk manager. You are the casino pit boss watching the dealers to make sure nobody is stealing chips. This journey is lonely. It is technical. It is frustrating. It is the exact opposite of the laptop lifestyle sold to you by the influencers. They sell you the destination because the journey is too hard to sell. But the destination they sell is a mirage. The real destination, becoming a consistently profitable, independent algorithmic trader, is real. It is attainable. But the entrance fee is not $49. The entrance fee is your ego. You have to admit that you cannot predict the future. You have to admit that you are not smarter than the market. You have to submit to the math. We started this series with a warning about a scam. We ended it with a roadmap for a career. The gap between those 2 points is where the 95% of traders fall and disappear. They get caught in the traps we expose: the grid bots, the B-book brokers, the signal rooms. They run out of money before they run out of ignorance. You now have the map. You know where the landmines are buried. You know that 99% win rate is a lie. You know that passive income is a myth. You know that the only thing you can control is your risk. The financial markets are the most competitive arena on planet Earth. It is a zero-sum game in the short term. For you to buy at the bottom, someone else had to sell at the bottom. For you to win, someone else often has to lose. The people on the other side of your screen are not amateurs. They are PhDs in physics, they are artificial intelligence models trained on petabytes of data, and they are banks with infinite pockets. But they have weaknesses. They cannot trade small accounts. They cannot move in and out of thin liquidity without moving the price. That is your edge. You are a guerrilla fighter in a land of giants. Stay small. Stay agile. Stay disciplined. This concludes our deep dive masterclass on AI Forex trading robots. We have pulled back the curtain on the industry, the technology, and the math. The rest is up to you. Do not let this be just another video series you watched and forgot. Take the warning seriously. Protect your capital. Respect the difficulty of the game. And if you choose to play, play to survive. Because in the game of trading, survival is the only way to eventually win. Thank you for watching.